IFRS 15, dealing with revenue recognition, has introduced a 5-step model into the accounting for revenue. The first of those 5 steps is addressed in this video, and in the standard there is a lot of requirements and prescriptions that are relating to identifying whether there is a contract with a customer. The primary issue at hand is having a look at the fact that revenue can only be accounted for if an entity has a contract with a customer. There's some important words here. What is a contract, first of all? Well, the standard goes on to define this as an agreement between 2 or more parties. This agreement can be verbally or in writing, but it must be enforceable, and that will depend from country to country on the laws in that country, whether someone has recourse to law to ensure the enforcement of a contract. Then this paragraph in IFRS 15 now has a number of requirements to be met to be able to qualify in terms of IFRS 15 as a contract with a customer. The first of these is that the contract must have been approved by the parties, whether written or verbally, and they must both be committed to perform their respective obligations. The obligations in this instance may be a transaction where the buyer has the obligation to pay the seller and the seller has the obligation to deliver goods to the buyer. The next requirement is that you must be able to identify each party's rights. This is almost a mirror image of the previous requirement, in that the one party will have the right to receive goods, the buyer will have rights to receive goods from the seller, where the seller will have the right to receive the cash in exchange for those goods. The third criteria is that there must be payment terms identifiable in this contract: cash on delivery, payments in advance, payments in 30 days, or whatever the instance is in that particular contract. Then the contract must also have commercial substance. There is a definition in the standard, and it appears on your screen now, talking about the risk, timing, and amount of the entity's future cash flows must change as a result of this contract. So something needs to change in your financial reports and your accounting records because of this contract. The entity must be better off or worse off, whatever the case may be, but there must be substance to this transaction. The final requirement, and remember you have to meet all 5 of these requirements to have a contract with a customer in terms of IFRS 15, which is your starting point to account for revenue. The final one is interesting. In the previous versions of accounting standards for revenue, one would recognize revenue and later on consider whether there needs to be a doubtful debts provision or allowance for credit losses. Collectability now has though been moved right into the first step in the accounting decision-making process. If there is doubts about that income being received, then you don't have a contract with the customer from the very beginning. So they're trying to prevent revenue recognized at an excessive amount and then later saying, oops, that we recognize too much, we better allow for doubtful debts. They're trying to stop the recording of that revenue right at the source. The purpose of all those steps that we've just been through within step 1 is to determine whether you have a contract with a customer. And if you don't meet those steps and you don't have a contract with a customer, there is no revenue to account for. However, sometimes it might happen that the customer has already paid you money and you don't fulfill those 5 requirements. What do you do with that credit entry in those instances? Well, you simply recognize it now as a liability, or commonly it's referred to as income received in advance, because you now have an obligation towards that customer of yours. Either you need to deliver those goods or you need to repay him the money. So there is an obligation involved, and you just create that as a liability until your contract requirements are met. And once those contract requirements are met, you're now moving into IFRS 15, and at the point where control passes over at step 5, you can unwind this liability through to your revenue recognition. Looking at a basic example of this, just for illustrative purposes, there might be a case of A Limited entering into a contract with B Limited, and A Limited will transfer a product to B Limited on 31 July. The full transaction price, though, is payable on 1 April, which is in advance of when the goods will be delivered. So looking at our journal entries there, on the 15th of April, you've received the money from the customer. You recognize this now as unearned revenue or income received in advance, which is a liability. And then on 31 July, when you've performed in terms of the contract and control of those goods has passed, you can now do your revenue recognition in terms of IFRS 15.